This is so exciting. You know what I think is really interesting? That people overcomplicate everything in life, us included. But the difference between completely winging it and then like sort of winging it, like what we're doing right now, think about how much time and energy it took to get here. It's crazy, right? Like, what did we spend? Like 2 hours to get ready to shoot this video? Bananas, bananas. All right, let's get back into it though. Let's so we're sitting here. People are going to tune into our podcast. What do they want? What are people interested in these days? I have a topic I'd like to just kind of rip into right now. I think that
I gotta tell you something that got fucking 250,000 views on my Twitter.
So what got 250?
Doom and gloom.
What got? All right. What is the doom and gloom report of the week? What are we talking about? 250,000 views on your Twitter. What was the content?
I talked to a bank, and they have quarterly meetings with all the bank CEOs. So I think this should be our topic. Let's do it. Doom and gloom.
Doom and gloom. All right.
People like doom and gloom.
People get really excited. They love the fear. They can say that they hate it, but they love it.
Let's do it.
It's like a car accident. All right.
Start.
Doom. We already started, dude. It's doom and gloom time here on the podcast and the Chris Ramsey show. We're just getting started. We got Chris Ramsey, David Schwartz. We're here to talk about doom and gloom today. So, Chris, you had something you wanted to share. What's going on?
I'm like the most optimistic person ever, usually.
Ever.
And bullish person ever.
Fair.
You don't get much more optimistic or bullish than me, usually all the time.
Sure.
And I still think there are good deals to be had and to be made out there.
People aren't here to hear your optimism. They're here to hear about the doom and gloom. That's what got their attention.
Yeah.
So let's jump into it. What'd you hear?
So, talking with a CEO of a bank that's publicly traded, they go to quarterly meetings where obviously all the bank CEOs, presidents, all the big shots of the banks talk.
And these are other presidents of other banks.
Correct.
It's like a union of bank presidents.
Correct. Basically, it's, they have meetings and they all talk, right, about the state of the market, what's going on. And
so basically, this is like a cabal of like all the guys who handle
Correct.
all the money. And what are they saying?
And his feeling, as well as the majority of the other CEOs, feel that we are in for a crash. And that's basically what he told me. He told me that he thinks property values are inflated. They're cracking down on loans. They're starting to tighten up their underwriting on these loans that they've been dishing out for the last couple of years. His bank and all the other banks included. Maybe not all of them, but the majority of them. And they're going to start requiring lower LTV for the loans that they do process. And that's the gist of it. And this is
larger
coming from
down payments, less exposure.
Yeah. And I'm not gonna say who the bank is, but it's a publicly traded bank and somebody that has a massive amount of experience and obviously is very intelligent. So I respect his opinion, and while I'm still obviously bullish a little bit for what I'm doing, it doesn't really affect me much.
All right. So let's not talk about you. People want to know about the doom and gloom. So you say a crash is coming. Can you be a little more specific? Are you talking economic, housing? Give me a little bit more there, a little more meat on the bone.
I mean, I would say that it's real estate. If property values are inflated, that's what they believe, then it's going to be probably a real estate. And I don't know what the definition of a crash is.
Sure.
We didn't really discuss whether he thinks it's 10% or 20%. But it's going to be a significant amount. So, I mean, I would guess 15 to 20% that the values would drop.
I'm going to be the happy guy here, and I'm going to say I don't buy that at all. I think more of we're looking at like an economic crash for the country. I feel like we have been borrowing a lot of money. The debt ceiling's been getting really high. We look at this is what I tell everybody, right? The historic average for interest rates, historically, since the beginning of time, is 7%. We haven't been at 7% since the 2000s, early 2000s.
Yeah, it's been a long time.
So you got to look at it's got to come back. So I'm telling everybody, and to your point, I think interest rates are going to go to 10. And I've been saying this for years.
Yeah, you have. You've been saying this for a while.
And I think the reason it's going to go to 10 are a few things. One, you look at why America was so strong in the 90s. It's because in the 80s and early 90s, interest rates were 10 to 15%. And if you're getting 10% as the interest rate, right, and you put money into a savings account, you're getting more money for savings. People start to think about how they're spending their money. They start to get a little more intelligent. Kind of playing into that economic crash, I can agree with that. I have a friend and a client of mine. His family owns a pallet company. They supply pallets to major manufacturers and distributors all over the Northeast. And what he's saying is when he starts seeing Coca-Cola and Pepsi and other big, huge brands lessening their orders over the summer versus increasing or remaining constant like they've been over the last couple of years, that's usually a good economic indicator that we're getting into, some sort of change. I think it's something that people need to be aware of. If you're overextending yourself with credit, be aware of it. I know a lot of friends and a lot of clients, a lot of people that want to buy houses, but they're in that vicious cycle where they have super overextended themselves with credit. They probably got credit cards they shouldn't have had in the first place. And now getting out of that and getting away from renting is just going to be really difficult. Doom and gloom, man. So,
but that's not who we usually are.
Correct.
But I mean, at this point, you have to think that something's happening. Where are we? We're at 8.5% interest rates. It's hard to buy things, right? The numbers don't pencil on a lot of the deals that we're looking at. Thousands and thousands of deals, and very few are penciling. I mean, we all know that prices skyrocket.
Well, let's talk about that, right? So let's talk nationally, and then we'll talk specifically to our area in the upstate New York. So upstate New York, we're kind of insulated. Even in 2006, 2008, we only went down 10%, right? Whereas when I was living in South Florida at the same time, it went from 100% down. You took like a 40, 50% haircut. New construction went off a cliff. And then it was a completely different atmosphere in 2008 down in Florida than it was up here in upstate New York.
Yeah, but I think everywhere, including Albany, Northeast, nationally, the values of commercial real estate specifically, and residential for that matter, skyrocketed, right?
Sure.
Very quickly. So, again, in talking with the bank CEO, that's a problem. Just like in stocks. If a stock rapidly increases, hockey sticks, it's going to come down eventually, right?
And you want to get off before it drops.
And that's
or be prepared to hold it until it comes back, because it will always come back. The question is it going to be in 1, 2, 5, 10, 20 years?
Right. And that's basically where he and many of his colleagues are. That's what they think. And at this point, I tend to agree with them.
See, I'm going to disagree. I'm going to remain the bitter optimist that the housing market is going to stay strong. And the reason I think that, and again, I'll specifically keep that's kind of my area of upstate New York. We're talking about a demand issue, a supply and demand. It's not a matter of artificial pricing. It's not people going and buying loans who aren't qualified. It's people who are very heavily strapped with cash, like the boomers who have no mortgages. They see a starter home come on. They don't care if they have to go 10% over if it's the ranch they need to downsize into. The house they're selling, the big colonial, is paid off. There's no mortgage. They bought the house for $180,000 in 1990. Now with appreciation and inflation, they're selling it for $600,000. They're going to take that $600,000. What does it matter to them if the ranch is $300,000 or $330,000? Now, what's interesting about that is 90 days from then, that sale, even let's say comps, when they go to contract, put that ranch at $300,000. So if it was a traditional financing, like with a bank would say, hey, look, there's no comps that support it going to $330,000, right? However, with people going and buying these starter homes with cash, it sets new comps with justify loans. It's kind of like a vicious circle. You add in a saturation of apartments, and still we aren't meeting the demand of housing that we have locally, and the rents have gone up dramatically. I think it will be really interesting to see how the government will intervene or not intervene when it comes to rent control. I think that's something that's a reality, because with inflation, the cost of housing and living it's gone through the roof. And I think that's going to lead more to an economic impact than a housing impact. That's my 2 cents.
It may be an economic impact, of course. There may be an economic factor that plays a role into it, but regardless of how it happens, it's going to affect the real estate market, right? At some point.
Absolutely.
At some point.
And it has to correct itself.
We just don't know when it is, but it's much more likely to be when interest rates are at 8.5% than it was when they were at 5 or 5.5 or 6, right? Because that's still not that bad, those interest rates. Everybody was crying about it.
Yeah.
But 6 still is not that bad. Even historically, 6 is not that bad.
It's below the historic
8.5
average.
is not good.
But
Even historically, it's not good.
Sure.
Right? So, a lot of these balloon payments, these loans,
interest only,
that come back, now they're coming back, they're coming due, these payments are going up. That's what happens.
Well, something TikTok won't tell you is if you're going to do the Burr method, buy, rehab, rent, refinance, you got to be careful in situations like this. Those investors that are getting really exposed buying something with other people's money, thinking that they can refi out, oh my God, the rates keep going up. They're not going to be able to refi out. They're going to be stuck with these super high interest rates. And guess what? They're going to lose their investments. And that's just, I think, the nature of what we're in right now. But I think what's interesting is there's a lot of people who leverage other people's money. And I think that's going to get really dangerous if we don't see some sort of correction in the next couple of months or years.
I mean, I do think it's great for hard money lenders.
Absolutely.
Because if the banks are at 8.5%, then hard money lenders can be at 15, 16, 17. Yeah. But wherever they are, it's still going to be reasonable, right?
Sure.
So it's very good for hard money lenders, and it actually brings hard money into play a lot more than it had been previously.
Sure.
So I think it's a great time for hard money, but I really think that there's some times when you have to be careful.
Sure.
And again, I'm bullish, optimistic, just about all the time. But I think that there's some times when you have to be careful. Again, if you're trying to do a new construction project, and now if things, you have wiggle room when you got a 3.5% interest rate. And if something happens and during your construction where things didn't go as planned, new construction's hard enough. Now with interest rates where they are, that wiggle room that you had where if something doesn't go as planned is not there anymore, right? So these are all things that you really got to watch out for. And I just think that at this point, it's inevitable that something has to give here, right?
What's crazy is I felt this even in 2018 when I was getting into the business, and I was like starting to be a full-time agent. I was like, you know what? Like there has been unprecedented growth since 2009. Like it literally has just gone up nonstop. The market has just gotten stronger and stronger and stronger. Prices have gone up and up and up. There always is a correction. Usually in the real estate market, there's cyclic changes, right? Where it's every like 4 years, give or take. And it kind of follows elections, guys. So when people are saying, oh, there might be some relief next year in the housing market, I disagree. I think before an election cycle, people get a little nervous. They don't want to go out and take a big plunge in terms of real estate. So I think what we're going to see is, again, I think we're going to see people battening down the hatches. I think we're going to see another probably 18 months of very, 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 very low inventory in the residential sector. I think when you go into commercial and investments, absolutely there'll be some opportunity there. But there's a reason why hedge funds control 25% of the non-owner occupied single family homes in America. I don't think it's because they're expecting a crash. I think it's because they know that over time people need a place to live. And there's not only increase, but there's, with appreciation and things grow over time, there's debt pay down from the tenants. And I think that as long as you're being intelligent, you're keeping some cash reserves, you're getting some savings together, you're really thinking about how you're spending your money every day. I think it's a good exercise for everyone. It's a good opportunity for people to kind of get ahead of it right now. So I think this is a really important message to get out there.
And I don't think that we're in the minority here. I think that there's a lot of people talking about what's going on and that now feel the same way, that some type of a correction is going to happen.
Correct.
Again, maybe it's not a crash, maybe it's a correction, difference of 10 to 20%. But I think that something has to give here. So that's where I stand. I mean, I think that people should just be aware of it and they should be prepared for it, basically.
Sure.
Right.
Do you know something that's really interesting? This website, Keeping Current Matters, it looked at how house home values have fared through the different recessions, going all the way back to the Great Depression. And you look at like, there's one in the 40s, there's one in the 70s, there's one in the 80s. Like they happen. 2008 was the only time that residential real estate lost value, and that's because that was the sector of our economy that caused the economic collapse. People were writing us subprime loans. They were giving people loans that didn't have any business having loans. That's not the issue today.
Yeah, the big argument between now and 2008 is that no one was prepared for 2008 and that everybody is prepared now or somewhat prepared.
Well, I know like mortgage lenders and originators really tightened up their qualifications for giving people money.
So, I mean, I guess I would agree that it's not going to be as bad as 2008, but also I have seen some insanely aggressive underwriting. And I've seen some deals that don't even pencil at 3 or 4% interest rates. So I don't know how those deals are now going to work when they're 8.5 and when
Well, something we've seen.
things have changed like that.
Well, let's talk about that for a sec. So something I know that I've seen since working with you for the last couple of years and starting to really underwrite a lot of volume of different types of deals is that there's people pushing the market expectations, whether it's that company that bought those 86 units in Altamont that at a price that just can't even wrap my head around. I think it was like a 3 cap, right? Like that doesn't even cash flow at a 3.5% interest rate. I think we're seeing a lot of people who are repositioning assets, people who sold because it was too good to be true, and then they don't really care because if it's buying a new asset class at a little over list price and not paying capital gains, it's a very different story than if you're putting down a down payment and going to traditional underwriting like through a bank. So I think commercially we've seen a lot of that, especially in our area where you see people from out of the area. Let's say even let's just look at Saratoga. Someone sells a 4 unit in Saratoga for $1 million. They can go to Schenectady and go buy what? 11 unit? And that 11 unit to someone who's only been in Schenectady, they're going to look at that and say that 11 unit's probably like 600,000. Because
and cash flow's a lot better.
Correct. So that's where it's all about perception, and I think.
Well, I think a lot of these people that are buying these deals are syndicators, or they're raising private money. That's great,
but it's generationally.
A lot of these people, a lot of these syndicators, and the people raising private money or funds are forced to spend money.
Correct.
They have to spend money. That's their business. They're in the business of finding deals. Now, what happens when they don't find deals? They start getting nervous. They don't want to lose the money. They don't want to lose the investor. They don't want to disappoint their investors. So they start making deals that aren't great deals. And that's when you get in trouble.
And I've also seen
that 86 unit that you're talking about. I don't understand the numbers on that one for the life of me.
What, to go for $24 million?
So a deal like that, that's some private equity. That's somebody that wants to take their management fee. That's something like that. And the guys that made deals like that and underwrote super aggressively are going to be in trouble. How about the syndicators that underwrote 2 or 3 years ago with an exit cap of 4 or an exit cap of 5?
Or 6.
Well, your exit cap is not 4 anymore.
It's now 9.
So it's a big difference, right? So you're not hitting your numbers even. You're not even coming close to your numbers when you're getting 8.5%. And you underwrote that deal so aggressively, you underwrote it at a 4 cap exit. So I think that's what we've seen the last couple of years. I think we've seen a lot of people that have been super aggressive and been successful to this point, even doing some unconventional methods, hard money, short-term loans, high-interest loans.
Well, do you know what I hate? I hate the guys who say, marry the house and date the rate. Like, that's the silliest thing I've ever heard. And in residential real estate, that's a very common colloquialism where people are like, marry the house, date the rate, get the house you want now. It's only going to get more expensive. You can always refi later. Can you? A lot of people look at these adjustable ARM loans where they're like, okay, it's fixed for the first 2 years, 3 years, 4 years. I won't even have a client consider going into an ARM product, which is adjustable rate mortgage, unless it's a 5-year fixed and that they can afford to make a 30-year payment on that. Because if they can afford to make a 30-year fixed payment on and they choose to overpay, 5 years into the loan, they've already paid down a big amount. They can always refi into a 30. But I think a lot of people that they got into a little over their head, and I think to your point, if there is a big correction, if interest rates stay high, we might not see it very quickly, but within 18 months to a year, it'll start snowballing.
But again, back to the banks, right? If they underwrote at a 5 cap, and now the refinance is a lower LTV, that profit is gone. Their profit is gone, right? Because now the banks are tightening up a little bit. So the banks want to give you a higher interest rate,
sure,
and they want you to keep more money into that project. They want you to have more skin in the game, right? So now that deal that you bought 3 years ago, 4 years ago, 5 years ago is not working out at all, and your investors are going to be highly disappointed in you.
Highly disappointed,
right?
What about
they might just want to dump it?
What about developers? What about, to your point, we were talking about residential new construction. What about commercial new construction?
Yeah, it's hard.
Because a lot of those people get a draw system where okay, we're going to buy it for this amount of money, and then we're going to get draws on our capital, to go and continue to develop as we get to certain benchmarks. The banks give them certain amounts of money. But at the end of it, they're going to want to get a mortgage And when that rate has doubled,
Yeah.
they're going to be in trouble.
And you better have factored that in. I mean, again, you should have probably seen it coming. But a lot of people are so aggressive and they wanted to make that deal work in their pro forma, in their underwriting. They wanted to make those numbers work. And you can manipulate the underwriting to make it look like whatever you want it to look like, right? But if you put that exit cap at 5, if you put that rate at 4, if you did these things, then you're going to be in trouble. And I think I know a lot of people did these things because I've seen the deals, I've seen the purchase price, I've studied thousands of these deals, so I'm 100% sure that's what a lot of people did, and that's going to definitely affect things. People they're going to be dumping the properties.
Sure.
Or they're going to be selling them for maybe little more, the same that they bought them for, who knows, maybe less. So, I mean, I think that's where we are going to be here very shortly. Now, what you did say with the election year is pretty interesting because historically, obviously, they try to keep things smooth during the election years. So it may be smooth, but
I got into a conversation with someone the other day. I go, you know what? If a Republican wins the office, right? I'm like, I'm not gonna say guarantee. I would be very surprised if interest rates don't come down, right? And the reason I say that is because when you look at the last few cycles when there was a Republican in the office, they were very favorable of lowering inflation, lowering interest rates, being pro-business. And someone's arguing, well, the Fed, the head of the Fed is the one who sets the rates. Like,
Yeah, but the party makes a lot of decisions also.
Correct.
So, I mean, there's just so many factors. So many factors into what's happening, whether it's economic, whether it's trade, whether it's real estate. And they all kind of affect each other, right? The election, all these things kind of affect each other, and it's very complicated.
Do you know what being in real estate is? It's like going to a casino. Perfect example. You can go to the casino with 10 of your friends. 10 of your friends can be in real estate, whether it's buying a single-family home, buying a lake house, buying apartments. It's gambling. Sometimes, sure. Like, if you've been watching the roulette table and it's gone black 20 times in a row, I would feel more confident putting money on red after seeing that than putting money on black to go 21. Fair enough?
I don't know. I might go black.
You're sicko. But I think about this. Like, if someone goes to the table, right, and they pay a $10 hand of blackjack, if they have $1 million in the bank and they lose the $10, they're still okay. But then there's people that will go there and play a $10 hand of blackjack.
A lot of them. A lot of the people in real estate are...
And then they chase it. They chase the high. They lose. They keep going. They try to...
Well, it's been very easy the last couple of years.
And like I look at the flippers that I started working with when I got into this business in 2016, 17, and those guys had done 2 to 4 a year as a general rule of thumb. They took pride in what they did. They used tradesmen. They did it right. They had to buy it in a certain buy box because they knew their exit had to be at a certain point. Then you get the young bucks, people of our generation or younger.
Well, a lot of the people that are buying real estate have never seen a crash.
They've never seen a crash.
It's only gone up. So why would they ever be fearful? They wouldn't.
They have no idea.
They wouldn't be fearful, right? So that's really where we stand right now. I mean, people have been extremely aggressive, and rightfully so, probably, right? The last 3 years, but now they're continuing to be aggressive.
Let's say there's an economic crash, right? Let's say it's economic. Let's say it's not housing. What's going to happen to all those people that are overextended that have tenants that are paying? We saw the government in New York during COVID stepped in and said, don't worry about it. That's a reality that we have to at least be aware of could happen in the future, right? And I see that a lot of these people who are overextending themselves, they need these cap rates. They need to have these rents at a certain number to refi. If all of a sudden they get some people that aren't paying, that I just think, to your point, there's going to be a lot of money lost by people who are over leveraged.
Yeah, I mean, they all affect each other. They definitely all affect each other. We know that a lot of people are heavily leveraged. If you're not, then you're probably going to be fine, right? I mean, that's why the bank want you to have lower LTV. That's why they want you to put higher down payments down. That's why they want you to have more skin in the game.
And they might be a little more strict on debt to income. Right, where they don't.
Oh yeah, of course.
And then I think they're also going to be stricter on credit.
But I mean, if you have 50% LTV, you probably don't have much to worry about.
No.
Right? You're probably going to be fine. So a lot of these smart syndicators, they raise a little bit more money. They have a little bit more cash reserves. I mean, I know at least in the self-storage, I've said it a little bit, we're preparing for a slower winter. We really are. We're bumping up our cash reserves. We're preparing for a slower winter because we see in my tech company and in the moving business, we see the moving has fell off a cliff.
Yep.
So the moving's gotten very, very slow this last month.
Do you know what real estate is down year over year right now in New York State?
What's that?
30%.
30%. So, I mean, there you go. So we're preparing.
And we're not even in a crash.
But there's people that aren't preparing, right? They think that this is going to keep going on, and they don't see these warning signs. And they're not keeping cash reserves. They're taking their cash reserves, and they're going to buy another building, right?
Or they're leasing a Mercedes, and they're buying the new iPhone.
Whatever they're spending
and they're
their money
going on vacation, and they're
exactly whatever they're spending their money on. But
so here's a question, Chris. If you knew that there was going to be an economic collapse coming, let's say 90 days out, what would you do to prepare yourself? What would be your advice to people? You've been in this game through 2008.
You have to be ready to buy. So get cash ready, or even more importantly, you should be prepared to raise money at all times, in my opinion, even if you're not a syndicator, or even if you're not running a real estate private equity firm. I think that you should have the ability to raise money at all times. But specifically, if there is a crash, you better be able to raise money, because when there's crashes, there's opportunities. So
let's unpack that a little bit. So when you say raise money, like, let's dumb this down, because like when you first started talking like this to me a few years ago, I think raise money. Like, I'm not buying a huge commercial building, but I think it's simpler than that. I think it's going to people who are high net worth individuals and saying, hey, look, if there's an opportunity, would you want to partner with me?
Yeah. So there's a lot of people out there, doctors, lawyers, dentists, that have money, engineers that have great jobs, that don't have any time. We, hopefully some of the people listening to this, are the real estate professionals, right? So we have the time. We know what we're doing. We can operate self-storage. We can operate industrial. We can operate contractor garages. So we have a specific skill set that sometimes I think is undervalued. And I want people to make sure that you know that if you have the ability to find properties, identify properties, and operate them, that is a very, powerful skill that you have, and that's in high demand.
Absolutely.
Because there's a lot of people out there with a lot of money that don't have the time to do those things. So, like you were saying, high net worth individuals, they could be, a lot of the times, especially if you're starting out raising your money, they're friends. They're family members.
And I'm not suggesting people go ask those people for their life savings. I'm suggesting, like, hey, look, if there's an opportunity, would you want to invest with me?
Yeah, and there's a lot of different ways to structure.
And I'll also say this: when people talk about that, before you even ask other people for money, make sure you have, if possible, 6 months of bills, of savings to cover your bills for a couple months.
Yeah, it's possible to just get a certain percentage of their. I mean.
Something my mentor said to me when I talked to him in the fall. I had just gotten married. I had some credit card debt, and I go, what do I do? He goes, you need to act as if you don't know when the next paycheck's coming. And I was like, what does that mean? He goes, go through your credit card. Go through your charges. Look at all those reoccurring charges. Eliminate them. Take a red marker and just strike them.
Yeah.
Do you need Netflix, Hulu, Disney Plus, Paramount, Amazon? No. Like, limit your exposure, limit your things. I mean, to this day, even when I buy Starbucks, I'm like, ugh, like, that's $5 for a cup of coffee that I could pay $10 for 100 cups at my house.
Yeah. Yeah, I mean, definitely it's always good to do that stuff.
And I think before you start worrying about taking other people's money, make sure your money's right at home. Because, at least I've seen this with clients that I've worked with, and even people that could have been clients and I ended up separating, is when you have enough money in the bank, you don't have to be as desperate. And then if something goes wrong, because whenever you're doing real estate, it's Murphy's Law. Something will go wrong.
So, I mean, it's great if the syndicator or the one that raises the money has some money that they can cover things if they go wrong. So, again, if there was a crash, if there was a correction, you just want to be prepared, whether it's your own money, whether it's your friends and family's money, whether it's accredited investors' money, whosever money it is, have the ability to raise the money. And if you don't right now, start. You always should need, your goal should always be to have the ability to raise money. What if, regardless of a crash, what if you find a great deal that's $20 million and you think it's worth 30?
I got it.
Yeah, but what if you do? What if you find a deal that you can get
Pick
for
up the
$20
phone
million
and dial 518-369-1359, and I will connect you with Chris, and we will make a lot of money.
So,
Very nice.
I mean, what if you find a deal like that? Would you be able to buy it today?
And
For 99% of people, the answer is no.
Well, let's talk even smaller. I remember when I got into this business, someone called me with a tiny little 2-bedroom, 1-bath house in Rexford, and they were like, I want $50,000. Now, it was in rough shape, but I'm like, I think I can get you like 80. They're like, oh my God, if you get me 80 with no inspections, like, we'll love you.
Yeah.
I'm like, I got him 80 that day. Like, it was like, and like, they were thrilled. So I got him 30,000 more. That kind of opportunity, the only reason my guy was able to pick it up for 80,000 because he had $80,000 in cash and he could close quickly. And to your point, like, deals don't wait for you to get financing.
No, absolutely. And you never know when a deal's going to come around and how fast that you're going to need that money. And again, if there's a crash, people don't know what's coming. They don't see it. Things happen fast. You need to have that ability to raise money so you can capitalize on these deals.
And I also think you got to get your credit as strong as possible. You know, take inventory of where your interest rates are, right?
Oh, I mean, of course, your credit is obviously hugely important, especially if you're in real estate game. You a lot of the time have to get the loan. So even if you're going to raise money,
or you have to use the money to do the rehab. You have to open up a Home Depot credit card to go throw $20,000 worth of materials to fix up the place.
Yeah.
But, you know, something I had a conversation with a client last week. They actually, after talking, they were going to tap their retirement to pay off some debt, right? Like they had, you know, I think it was $40,000, and they were like, look, we're going to take this money out of retirement. We're going to draw it. They're only in their 40s or 50s, so they're going to get penalized, but they're going to pay off their credit cards. I go, how long have you lived in your house? 8 years. I go, let's go to the bank. Let's get you in touch with someone to see if you can get a home equity line of credit. They were able to get a fixed 15-year loan, the first 4 years interest only, at 6%.
Yeah, that's nice.
Their credit card was at
24 probably.
20%.
Yeah.
So guess what? They just paid off all their debt with this home equity line. And for the first 5 years, it's interest only. We worked out the payment for the same amount of money that she was paying. She can pay off her debt using the home equity line and be debt free in 5 years and still have her credit intact. And now she's got $30,000 or $40,000 on her credit card.
Yeah.
So if something happens, you can use it. I think.
And again, even for no matter what your deal size is, no matter if it's 20 million, no matter if it's 100,000, right? Whatever's big to you, right? You need the ability to come up with that money. The one who has the money and the one who has the deal, those are the ones that control things, right? And if there's a lot of deals, then it's the one who has the money that controls things, right? So you really need that ability.
I think it's that. I think on one side you got to build out your finances, right? So that's your personal, like outside financing, like you need to get your money right. But I think number two, which I want to also kind of put out there for people, is build up your network, right?
Because that's raising money, right?
Well, you say that, but
finding deals.
But for example, let's go back to your $20 million deal, right? Like let's say someone wants $20 million for an apartment complex that's worth 30. But let's say, Chris, you don't have $1. But you know the guy who needs 20 million because if he doesn't get the 20 million, he's going to lose it. He doesn't own anything on it. So for him, 20 million or zero, it's a no-brainer.
Right.
I don't have 20 million, but you know what? I know Chris Ramsey. And maybe if Chris doesn't, he knows someone else. And that's how, if you know the right people and you can protect yourself, you can always capitalize on opportunities.
And that's what a lot of the social media game is, right?
Wholesaling.
Right? A lot of the social media game is connecting yourself with like-minded people. So when you find that $20 million deal, you can call and say, hey, I have this deal that's worth $30 million. We have to buy this. And that's powerful stuff. And those deals come around. Imagine if you bought in 2008. Imagine how rich you would be.
Imagine if you bought every two-family in Schenectady in 2008.
Imagine if you bought anywhere.
Yeah.
Imagine if you bought in South Florida.
I did. I bought a condo in 2009, actually. One of my good friends, Sean.
In South Florida, right?
In Boca Raton. My good friend, Sean, called me. He goes, dude, you got this townhouse. You and your girlfriend just broke up. What are you paying for rent? I was like, I think $2,500. He's like, $2,500? He goes, you could buy this condo. I go, what are you talking about? And he'd been trying to get me to think about buying for a couple of years because he was a realtor in 2006. So, like, he went through the bloodbath that was that correction. So he was always trying to get leads and prospect that. As a realtor now, I see that. But when he told me that I could afford a condo, I go, all right, let's go look at it. I'll never forget. I went and looked at this condo and I ended up buying it for $171,000. In 2005, do you know how much it sold for? $435,000. In 2016, I sold it for $280,000 after doing nothing to it and paying it down, having 2 roommates. And I thought I made out like a bandit. Last year, I went on Zillow and it sold for $585,000.
But imagine if you had bought that when you did and sold it.
What if I never sold it?
What if you never sold it?
What if I refied?
Yeah.
I mean, I think that's...
So again, that's when wealth is made.
This game is amazing.
But again, that's when wealth is made, right? Wealth is made during corrections. Wealth is made during crashes. It's going to be very hard right now, today, to really make extreme wealth fast, at least, in real estate. With interest rates the way they are, with prices the way they are, it's going to be very hard to do it and make what we would call wealth, right? But during a crash, there's big opportunity.
I agree.
I mean, that's a great time. It's like buying stocks when COVID happened. Stocks cut.
Don't even talk to me about stocks.
Stocks cut 80%. No, but it's the
I
same.
I hate stocks.
It's the same idea. Imagine if you bought, when everything crashed during COVID, you bought stocks. That's when wealth is made, right? It'll take you 10 years to make how much you would have made if you bought a couple of those stocks at the bottom.
I saw something crazy when I was looking at retirement with my wife. We were looking at, like, the benefits, right, that go with, like, her investment, safe harbor. And something that the guy said to me, which I thought was really interesting. If you took out your money out of retirement for the 2 best days that happened in the last 3 years, you would have lost out on the opportunity to grow your portfolio by 75%.
Yeah, it's true.
75%.
So, I mean, so what we're saying is true. But, I mean, I guess to summarize this whole thing, right, at some point...
Buckle up, people.
Well, no. At some point, there is a correction or crash coming, depending on the percentage that things go down, right? Of course, everybody knows that. At some point, it's happening. With talking to the banks, with talking to people that are well-respected and very knowledgeable, they think that it's coming sooner than later, and that's why they're tightening up. If all these very smart people are tightening up, they're doing it for a reason, right? And I guess the other thing to summarize, which is even more important, even if a correction or crash doesn't happen, is you really need the ability to raise money to capitalize on a deal that could come across your way, regardless of if there's a crash or not.
Absolutely.
If there's a crash, you'll get a ton of deals. If there isn't, you're still going to find some deals. And you need to be able to raise the money or have the money somehow to buy those deals, fund those deals, and make those deals happen.
It all comes through your network. You know, I think of a good analogy to kind of end on this. If it's foggy, if you're going through a blizzard, are you going to be going 70 miles an hour? You know, in real estate, people have been driving as if you can see for 10 miles in front of you. They're going pedal to the metal. They're pushing it as hard as they can because there's been a tremendous amount of equity and opportunity in the real estate market for these last few years. But imagine how there's fog rolling in and you can't see more than 30 feet in front of your car. The question is, are you going to be going 70 miles an hour, or are you going to see that there's fog, slow down? Then at least if you hit something, you're hitting it at a reasonable speed and you're not going to total. And I think that, you know, for everyone, it's not going to hurt, to your point, to prepare for the worst and
hope for the best.
Hope for the best. But don't be naive.
No.
Don't be naive.
Don't be naive. All these smart people are not. They're not stupid. So, I mean, I would at least prepare and think that there's a possibility that it's
what
coming.
Goes up must come down.
At least be prepared. And know that there's a possibility. No one knows. No one has a crystal ball, but be prepared that, you know, it could come, right? We knew it wasn't going to happen in 2022 when interest rates were 3. No one was saying there was going to be a crash then. So, I mean, we're saying now, there could be, right?
I think people were kind of saying, like, you know, at least when I was in the residential side of it during 2020 when we came out of COVID, and it was like a freight train. It was like an explosion. It was like a cannonball. Everyone was going. It was 1,000,000 miles an hour. Everything was moving super fast. And people were saying it couldn't maintain that way. It couldn't keep going this strong. There's going to be a crash.
There could be.
I tell everyone this, it's supply and demand. And I think if there's economic hard times, demand will go down. And if demand goes down, supply will go up. If supply goes up, the price come down. And that's why the Fed keeps raising interest rates. So whether it's made by the Fed with interest rates and the ending result will be at some point a correction in the real estate market. And the question is, what are you doing to prepare?
Yeah.
If you guys have any questions or if we can help you in any way, I'm David Schwartz. This is Chris Ramsey. And guys, whether it's connections, questions, you let us know. We'd love to help you. Thanks for watching.
Thanks, guys.